China expands its source of investment in the stock market. The government gave the green light to pour the massive pension fund into shares. Only 30% of any pension fund can be invested in the market. China's Social Security Ministry and the Ministry of Finance will monitor the investments. According to official data, the amount of pension funds in China is about $580 billion. Well, the value of those investments will depend on what happens in Chinese and global stock markets. And for more on that, we're joined in New York by Allison, the CEO of Unio Capital. Thanks for joining us today. We appreciate it. Nice to have you back on the broadcast.
Thank you for having me.
Let's talk about Friday's day on Wall Street, the worst we've seen in 6 years. Can you put it into context and tell us what impact China has had on this?
It's a very good question. So let me just dealing with last week alone. On one level, this was just another correction. You know, every year there are about 3-5% corrections, and one wouldn't worry normally. However, this is a little bit more than that, and it started to cause people to look back to September 2011, October 2011, when actually a correction emerged of about 19%. So I think it got people a little bit worried. I think what really spooked people was the concern that maybe China, emerging markets, commodities all at once were going to lead to something bigger. And that's your question about context. So if you to put the thing into context, and I'm really going to step back a second here, if you look at the period we're in a long-term 10, 20, 30-year period of dislocation and structural change, which is very different from what happened from 1947 to 2007, which is a period of expansion and growth. And in that structural change, there are, think of 4 people on a merry-go-round. One of them is disinflation, one of them is deleveraging, one of them is disappointing growth, and one of them is directional change in China. And as the merry-go-round goes around, one person comes into focus. And right now, China's in focus. China's not the only part of this. It's just 1/4 of the whole thing. But right now, it's in focus. And what's in focus for China, I think what has people concerned is, number one, China is moving away from an export infrastructure-oriented economy. Number two, it is moving toward new types of businesses, which could be very good, which is why the Shanghai market has so many new IPOs. They're looking for new value-added businesses. It's moving away from a debt-leveraged kind of economy to an equity, less leveraged economy. And then people are concerned about what I would call the secondary and tertiary effects. A secondary effect would be commodities, which are connected to China's slowdown. A tertiary effect would be something like emerging market debt. If the emerging market debt has defaults, one could link it right back to China. So those are sort of the 5 big worries about China. But if you sort of step back a bit, China is just one of those 4 big drivers of this era we're in of dislocation and structural change, which, by the way, while it's not a pleasant era in many respects, it can lead to a lot of good things down the road. It's just that it's a rough period that we're going through. Does that help?
Yes, it does, John. But fear can sort of feed off itself. So what would we expect tomorrow? What should we expect? Another wild ride?
Well, okay, that's a great question. I wish I was this omniscient guru. I don't know anybody who really knows the answer to that. I'd say, you know, from a human standpoint, if things were bad last week, you know, one would expect things to start off bad tonight. But frankly, I think it's completely unanalyzable and unknowable. I'll tell you what I think is important to figure out. To figure out what exactly should we be looking for in what happens tonight and in the coming week, and whatever we do find, what should we do about it? So, for example, what we're looking for at our firm, but this is a general idea, I think you should be looking for, is this a problem of China slowing and emerging markets slowing, more of a demand problem the way you might have a company's sales slowing, or is this a demand slowdown plus a debt default problem? For example, there are a lot of emerging markets that have serious debt issues, dollar debt that they owe, dollar debt their corporations owe. If it's the latter, if it's demand slowdown plus a debt problem, then you've got a serious problem. If it's just the former, China slowing down, which frankly any intelligent observer knows that China has to slow down, then you have probably more of a correction rather than a big bear market.
Quickly,
so I think that's really the thing that I'm looking for.
About in the U.S. economy, I'm sorry to interrupt. Let me ask you, the Federal Reserve winding down on this huge stimulus effort. We do have strong employment numbers. Will the U.S. economy be resilient in all this? After all, this did break a 6-year run.
You're absolutely right. I mean, the Fed has been, as you know, many have said, the elixir of the equity market. So there's no question what the Fed does is a big issue. But our view and my view is that the Fed actually would like to raise rates. Everything it communicates is it would like to do it if it could, to get this beginning of normalcy behind it. The people who are actually more worried about the Fed and its raising rates are those observing the Fed rather than the Fed itself. So our basic view with the Fed is that as regards international markets like China, emerging markets, it takes those things into account, but ultimately it is a U.S. monetary authority. It's going to be driven by the things you were talking about earlier, about labor market strength in the U.S., less by China, unless China or emerging markets or anything like that were to lead to some systemic risk problem, you know, through some big debt default issue. But
John Allison,
right now,
thank you.
I don't think that.
We're
You're
sorry
quite
to
welcome.
wrap you. Thank you so much. We appreciate your time. Always great to see you.